This presentation will outline expected growth for Superior Energy Services and our expected price on November 4th, 2016, based on our company, industry, and risk analysis. This graph of Superior's recent stock performance is a reflection of the high volatility of the overall oil and gas sector. Superior's stock price has dropped from $36.70 in August of 2014 to $15.56 in November of this year. As will be discussed later, a drop in commodity prices has driven a downturn in the oil and gas sector as a whole, and Superior is certainly no exception to that. Superior Energy Services is a diversified, mid-cap provider of products and services for drilling, completion, and production needs in the oil and gas industry. Based out of Houston, Texas, it serves clients in the United States, Gulf of Mexico, and around the world. Superior started as an oilfield products manufacturer in 1989. By the mid-1990s, the company provided a wide range of specialized equipment for the oil and gas industry. In 1995, the company initiated a public offering and used the resulting capital to fund over 10 strategic acquisitions. Superior expanded into oilfield services in the late 1990s and early 2000s, while also moving into international markets. It developed a large offshore market by the late 2000s. The growth in shale drilling prompted a shift back onshore around 2012. After establishing itself as an oilfield products manufacturer, Superior expanded rapidly into oilfield services through strategic acquisitions, and the company used that same strategy to gain an international footprint. The company has tried to position itself to meet industry trends, as demonstrated by its expansion into offshore applications in the Gulf of Mexico, and then diversifying into many differentiated segments and eventually focusing on new geographical markets and hydraulic fracturing. Now, Superior is attempting to balance its business across all markets and segments with an emphasis on gaining more presence in international markets. Now, that being said, its onshore completion and workover segment in the United States land markets still comprises a majority of the company's revenue. Superior is part of one of the energy industry's many subsets, oil and gas field services. Service companies assist oil and gas exploration with highly specialized products and services in all phases of drilling and completion around the world. Superior provides the necessary equipment for operations in addition to services designed to increase efficiency and improve overall well operations. As a result of the 2014-2015 collapse in commodity prices, oil and gas service companies have begun to consolidate, highlighted by Halliburton's proposed purchase of Baker Hughes and Schlumberger's purchase of Cameron. Despite oil and gas service sector's current weakness, many analysts project the overall value of the industry to increase to roughly $290 billion by 2019. That represents a 43% increase from 2014. Commodity prices, shrinking rig count, and excess of supply are just a few of the industry drivers that determine the margins and efficiency of the oil and gas service industry. Oil and gas service companies have to operate on exploration and production company margins, which are set by commodity prices. In the current commodity market of $50 oil and $2.60 natural gas, it's difficult for exploration companies to be profitable, and many are going bankrupt. A lower client base and decreased spending by surviving companies has forced Superior to decrease its prices in order to stay competitive. This can be seen in the marked decline in revenue between 2014 and 2015 in all four of the company's service sectors. Figure 2 shows the declining commodity prices for West Texas Intermediate and Brent crude, the two most commonly traded crude commodities in the United States. In the last year, rig counts as tracked by Baker Hughes showed a continual decline. This shrinking rig count demonstrates the bearish market in which Superior operates. Fewer rigs in operations means less work for the entire services industry, which has contributed to Superior's decline in revenue. Figure 3 depicts this trend. Schlumberger is the largest company in the oilfield service sector and one of the largest companies in the world. Schlumberger operates in over 85 countries globally across the oilfield service spectrum. Headquartered in Houston and Paris, Schlumberger invested over $1.2 billion in research and engineering in 2014 alone. Additionally, Schlumberger has acquired Cameron International for $12.7 billion. This deal is expected to close in the first quarter of 2016. Cameron International was founded in 1922 on the invention of the blowout preventer, a piece of technology that's still used on every oil and gas well in the world today. Cameron offers a wide range of products and services, including substantial subsea production and processing systems. As mentioned earlier, Cameron was acquired by Schlumberger for $12.7 billion. Halliburton was founded in 1919 and is headquartered in Dallas, Texas. The company operates across the entire upstream oil and gas industry, providing a wide range of services throughout the life cycle of the reservoir. Halliburton has agreed in principle to acquire Baker Hughes for $34.6 billion. This transaction is currently under antitrust review. Baker Hughes was founded in Houston, Texas. In addition to the variety of oil and gas services to exploration companies, Baker Hughes also provides industrial support and services in the downstream sector. Should Halliburton's acquisition of Baker Hughes stand up under antitrust review, it would mark the merger of the second and third largest companies in the oilfield service sector. Nabors is one of the largest land well servicing and workover contractors in North America. It was founded in 1952. Nabors focuses its services on land and offshore drilling. Founded in 1941, Weatherford International has dual headquarters in Alberta, Canada, and Houston, Texas. Weatherford lists its products and services as drilling and formation evaluation and well construction, completion, simulation. Helmerich & Payne is headquartered in Tulsa, Oklahoma. H&P's primary service segment market is the development and rental of rigs and rig equipment. Patterson-UTI was founded in 1978 and is currently headquartered in Houston, Texas. The company provides drilling and pressure pumping services and owns one of the largest fleets of land-based drilling rigs in the United States. Outside of its services, Patterson-UTI is also involved in the exploration of natural gas. This slide shows year-over-year return on invested capital across the industry. Superior's 2014 return on invested capital comes in just below industry peer average at 5.5%. Demand for Superior services and rentals is highly correlated to the price of oil and gas products. Historically, the price of crude oil and natural gas has been highly volatile. Demand for Superior services can change quickly with changes in the price of oil, as well as changes in the number of oil wells that are drilled and completed. This presents a huge risk that Superior and other oil and gas service firms must continually reassess. With oil price declines, there's a high probability that the capital expenditures of exploration and production companies will also decline. This is because many of the E&P capital-intense projects become unprofitable due to low oil prices. In 2014, Superior operated in over 70 countries with roughly 15% of total revenues tied to operations abroad. Superior plans to continue to grow its international business into the future. Superior is subject to differing regulatory structures in each of the foreign areas where the company operates. Other risks that could potentially damage Superior's operations in these countries are political, social, and economic stability, trade sanctions, adverse tax policies, as well as the nationalization of assets. Regarding labor unions, Superior faces potential risk in certain international operations. Approximately 7% of its employee base is tied into union contracts, all of which are based in international locations. All of these factors pose serious risks in operations outside the United States. Due to the cyclical nature of the business and the high degree of technical labor necessary to complete many of the services offered, Superior needs to hire and retain a skilled workforce is vital. The industry is currently experiencing tremendous layoffs as companies try to cut costs. Through this downturn, Superior must not only focus on maintaining margins and its current cost structure, but also must realize that these technical employees are a critical stakeholder, not just an expense. Superior must manage its talent and its technical and intellectual capital. With about 18% of Superior's total revenue in 2014 generated in the Gulf of Mexico, Superior faces risks associated with seasonal and severe weather conditions in the Gulf, as well as in other parts of the world in which it operates. These weather conditions can negatively impact Superior's operations in a variety of ways. Extreme winter weather and blizzards in the northern part of the United States, as well as high seas and hurricanes in the Gulf of Mexico, can result in suspension of services, evacuation of site locations, damaged equipment, and reduction of overall productivity. Not only does harsh weather affect the operations, but changes in weather patterns also affect demand. Recent oil spills have also put tremendous pressure on the industry to make sure that training and safety protocols are up to date. Regulatory agencies continue to increase the level of restrictions and regulatory compliance within the oil and gas industry at both the state and federal level. Industry regulations focus on environmental protection, the movement of raw and hazardous materials, and worker safety standards. As regulation increases, Superior's costs and operations could suffer. In regard to environmental protection, the oil and gas industry's hydraulic fracturing process has been under recent scrutiny. Further restrictions on fracking can pose a serious risk for Superior because many of the services offered are related to this line of business, with some states having banned the process altogether. Not only does Superior have to worry about changes in government ruling and regulations focused on the environment, but Superior must also aggressively protect trademark and intellectual property that will help Superior maintain its competitive advantage in the industry. Superior currently has a $1 billion bank credit facility broken down into a $600 million revolver and a $400 million term loan. As of July 31st, 2015, Superior has no amounts outstanding in the revolver and roughly $43 million in letters of credit outstanding. Due to its global operations, Superior must continually monitor currency exchange rate risk. The majority of its revenues are denominated by the U.S. dollar. However, some revenues are paid in foreign currency where the company operates. Superior's attempt to mitigate this risk comes in two ways. First, Superior enters into forward foreign exchange contracts if it foresees some volatility in that particular currency. Second, Superior also pays for operational expenses with an area's currency, alleviating the currency's fluctuation of that area. As of June 30th, 2015, Superior was not bound to any foreign currency forward contracts. Historically, Superior has danced the line between distressed and gray zones as seen in this figure. For the year 2014, Superior is in the gray zone with a borderline score of 1.83. This analysis is more of the same in their books. It is a slight increase from the disastrous lows of 2011 through 2013, but Superior has not been safe since 2007. In his book, One Up on Wall Street, Peter Lynch explains a powerful charting tool he uses to decide which stocks in which to invest. He compares the company's historical price to its theoretical 12-month lagged earnings per share multiplied by 15. If the stock is trading above the price, Lynch would advise that investors do not purchase. He would advise that investors purchase when the stock is trading well below the 15 times earning per share. Below in this figure, we see that the stock is currently trading well above the trailing earnings per share ratio and thus is not a good investment. Ben Graham is considered the father of value investing. Graham's process for discerning value investments involves 8 hurdles that evaluate stocks to determine undervalued companies and prime targets for acquisition and investment. The first 6 hurdles determine whether a stock is underpriced, and the remaining determine growth potential. Superior meets 6 of the 8 hurdles. These indicate that Superior is an undervalued stock with some growth potential. However, an investor should consider that our analysis predicts a negative trailing earnings per share. Our analysis expects many of Superior's competitors to have similar negative net income in the coming year. Many of these factors are affected by the cyclical nature of the oil and gas industry. Oil and gas was in a boom from 2010 until 2014, and the ramifications of its latest bust have yet to be fully felt. While this company may have been attractive to Ben, further research would need to be accomplished before investing in the energy sector at this time. Though we tested many internal and external variables for our regression, we ultimately used the horizontal rig count, Gulf of Mexico rig count, the international rig count, and projected PP&E for Superior. We tested each rig count lagged by 0, 2, 4, and 6 quarters, then used the most statistically significant input. To project rig count through the fourth quarter of 2018, we increased each input on a quarterly basis directly proportionate to the relative West Texas Intermediate crude oil prices. For projected PP&E, we relied upon our financial model, which predicts that conservative operations will result in a continued decline in PP&E through the second quarter of 2017 and then holding flat through the fourth quarter of 2018. Now, for our growth model, we used a rate of 3% annual revenue growth. To get this number, we analyzed Superior's historic growth trends and eliminated outliers caused by events such as the Complete Production Services acquisition. While Superior might acquire assets from Halliburton from the Halliburton-Baker Hughes merger, we do not account for any such activity in our model. We also did not account for potential sales of Superior's business line or for the operating leverage that might be created by de-siloing business lines. Finally, we give Superior Energy a market underperform rating with a 12-month target price of $14 per share. In order to reach this conclusion, we integrated Superior's financial data into a regression model to generate projected revenue through the fourth quarter of 2018. From 2019 forward, we applied a growth model based on Superior's historic performance. We project steep revenue declines through 2016, at which point our bullish oil price projections will result in a steady rebound. Thank you for listening to our report. Our team put in a lot of hard work and we're really proud of our product. So thanks again.